Jamaica is a highly prospective target area for different kinds of deposits in an island arc terrain.
As probably the most widespread, intensive, and in-depth exploration program that's ever been carried out in this island.
5 or 6 years worth of work into just 2.
No one else has ever done this before. There has been historic work on the island, trending back 150 years.
I think they're getting excited, as we are, so stay tuned.
Hi, my name is John Reade and I'm the Chief Market Strategist at the World Gold Council. I'm delighted to be joined by Paul Brink, CEO and President of Franco Nevada. Thanks for joining us, Paul.
Thank you for having me, John.
Look, I've got a number of questions I'm going to ask you, so let me just jump straight into it. In the last 6 months, we've seen gold bullion and gold equities off substantially. What sort of themes do you hear when you speak to your investors?
I'd say the major theme is, ever since vaccines were proved effective, we've seen a big thematic shift in the market, and it's been a shift towards cyclical growth. Very well warranted, but that's also seen money come out of gold, which was a good defensive place to be in the initial stages of COVID. The real question that investors are asking us as we go into this is, how will the cycle end, and are we going to see inflation at the back end of the cycle? I was just looking at some numbers earlier on today. Put in perspective, in the US, they had about $2.5 trillion of stimulus last year, just approved another 1.9 trillion, talking about another 3 trillion on top of that. So added up, you're in the order of $7.5 trillion of stimulus. And to put that in perspective, US GDP is 20 trillion. So we're looking at an amount of stimulus that's 30-40% the size of economy. It's an incredible amount of stimulus. Undoubtedly that alone would lead to inflation. So the second question then is, what about the monetary side of policy? Will the Fed be a dove or a hawk? I think Powell's comments last week were very clear. The focus is on employment. It's not on inflation. So I think both sides of that lead you to the back end of the cycle. We're certainly going to see a good amount of inflation.
Yeah, it's an interesting one at the moment, isn't it? Because you can see that it's almost as if the bond market is pushing the Federal Reserve into making a very clear statement about what it's going to do. And yet every time they do speak, every time Powell comes out and reiterates the fact that they're going to let inflation go through their 2% target, at least for a while, it's as if the bond market doesn't believe it. And I suspect while we continue to see bond yields trading higher, it's going to keep gold equities and gold on the back foot, at least in the short term. Another topic that's come up a lot in conversations I've had is Bitcoin and cryptocurrencies. Do you hear those when you speak to your investors? Is that something that they are interested in? Is it on their mind, or has it not been a big topic of conversation?
It is a topic that comes up. Although, when you look at our investors, for the most part, they're big generalist investors. They're running a lot of pension money. They, by nature, I think, are very different from most of your Bitcoin investors. While there's some commonality, obviously, in the themes between gold and Bitcoin, and that's to protect against the erosion of the value of paper money, I think they're also very different in major ways. Gold is largely a hedge against market volatility. Bitcoin, on the other hand, really is leveraged to market volatility. Yeah. I think by the numbers, Bitcoin's 4 times more volatile than gold, and with a much higher correlation to the market. So while there's a bit of overlap, I think fundamentally different classes of investors that are looking to invest in the two things. Most of our investors are looking at gold as insurance. It's 2,000-year history as a store of value. And whereas Bitcoin, it is much more of a speculation. One of the themes in this market, though, that's driving it is because of all that stimulus, there is a huge amount of discretionary capital that's been made available. That discretionary capital, often new investors, they're pursuing momentum trades, and we had all various stories on those various types of trades, but Bitcoin is one of those momentum trades. So I think for the most part, very different investment bases between the two.
Yeah, and that certainly fits with the work that we've done on this topic. As you say, they're quite different, even though you often hear people saying Bitcoin is digital gold. When you actually look at the characteristics and the performance and the correlations and what it does for your portfolio, really very different beasts. But sticking with the topic of important debates in the market at the moment, the ESG focus of institutional investors in particular continues to intensify. What does ESG mean for a royalty and streaming company that doesn't operate its own assets? And how do investors get comfortable that you will help them advance their ESG objectives?
Well, starting on it, the three pieces, obviously, to the stool there, the EAS and the G. Not being an operating company, it means we start with the G, governance. It's the most important thing for our company. And it means holding ourselves to high governance standards. Of that, two really important things. And the first is alignment with shareholders, alignment in terms of outcomes. We always take the approach, for our team that we should act as owners, not as managers of the company. And that means owning a lot of stock ourselves. It means keeping salaries low, G&A low. And it also means for the compensation of management that it's very much oriented to stock-based compensation and long-term performance-based stock compensation. Make sure that we get that alignment with shareholders is the very first thing.
Yeah.
The second thing is diversity. The creating a safe workplace and a workplace that welcomes diversity into the workplace. Moving on then from governance and onto the E and the S, we take part of our responsibility is to make sure that we are promoting responsible mining. And that means, for us, our point of impact is when we make an investment. We're largely passive thereafter, not completely. But our biggest impact is where do we allocate our funds? It means doing due diligence, doing on-the-ground due diligence, paying attention not just to the technical things, but to potential environmental impacts of the operation, whether it has the support of the communities, whether it has a net benefit of the communities are obviously big focuses for us. In entering into those deals, we're encouraging operators to commit to responsible mining standards. Very often for gold miners, it's the World Gold Council, responsible gold mining standards. We do ourselves get active in contributing to the communities, making sure that there is that net benefit, that there is positive spin-offs for the communities. And also something we've now started engaging with operators on is how can we help them meet their other ESG objectives? One of growing intensity is around the carbon footprint. Yeah. Are there projects that we can support to help them achieve advancements reducing their footprint?
Yeah, it's a crucial area, and you will have heard it described many times as a license to operate, and it must be something as a royalty company or a streaming company that you really care about, because anything that threatens that license to operate obviously is big trouble for even a royalty and a streaming company.
And in the 13 years while we've been doing it, that has been the case. So I'd say a lot of it is enlightened self-interest. Mm. Our practices around due diligence, I wouldn't say have changed much over that period. What has changed is the level of shareholder attention to the issue. And so we have to communicate more about what we're doing. But we recognize our role is as an allocator of capital. And shareholders want transparency. If they're investing in Franco, they want to know, what are the underlying operations that they're investing in, not just the technical aspects of it. So we are working hard and every year improving our disclosure and transparency to give them a look through to who are the operators, what are their ESG credentials, what is their climate footprint, so that investor that is looking at Franco can see through and much like a mutual fund, understand what are the assets that they hold in the portfolio.
Franco's always had a broader range of commodity exposure than other streamers, including investments in energy. How do you see that commodity mix changing over time?
The focus of our business is always on gold and precious metals. And to the extent that they're good deals to do in the sector, that's where we spend all our time. But there are times when it gets overheated in the gold market, it's too expensive to add assets. There are other times, much like the last 4 or 5 years, there just wasn't a lot of capital being spent in the industry, and so they're not good places to invest your capital. We've always said to investors, give us some latitude, let us invest in other commodities when that's the case, so that we can keep exposing shareholders to good resource optionality, even when it's not available in the gold sector. So that could be in other metals, that could be in energy. It really is driven by what are those, which assets have good resource optionality. When we think of metals at the moment, the really two areas that are attractive, and the one is particularly in the base and the bulks, you can get something that you can't often get in the gold industry, and that is long reserve lives.
Yeah.
Those are assets where much easier you can drill up 30, 50 years of reserves, if that's copper or iron ore or potash. We love to have those in the portfolio because it really makes it tangible that we're going to be in business for 30 or 50 years. The other side of it on the metals are battery metals, and as we look to the world becoming greater electrification, what are the metals that'll benefit? Again, copper and nickel, battery metals. So really, in terms of exposing ourselves to exciting commodity optionality, those are also attractive sectors.
Yeah, no, that makes a lot of sense. You've had the unenviable task, almost a baptism of fire in a way, of stepping into the CE role at Franco just after the onset of the COVID pandemic. What should investors expect from Franco under your watch, perhaps under more normal circumstances than we've seen in the last 12 months?
Well, I would have loved that stepping into the role, we were in a position to do more deals right off the bat. We have been able to add some interesting assets, but in a COVID environment, doing due diligence obviously is a limiting factor in adding more assets. But more broadly, in terms of the business, the first thing is Franco has done so well in the past, has such a terrific track record of making investments that don't fix what isn't broken. But at the same time, the environment is changing that we're operating in, and so to me the key is make sure that you're adapting the business as the environment is changing. And a change for us of our history, we started as a royalty company, buying third-party royalties. You are very passive in that respect. Where the industry has changed most is now our bigger deals are all streaming deals. And in a streaming deal, you're providing financing directly to the operator. And the beauty of the model is we're only successful if the operator is successful. It means we need to pay more attention to that alignment. We need to be supportive of the operators so that the two of us can be successful over time. So there is more of an operator focus, ensuring that they do well out of the deals. And the second part of it is, as you spoke earlier, is social license. That's always been a criteria, but it's a growing criteria in any investment. When we look at deals, it's not just tons of grade anymore. So much of it is environmental impact, particularly the communities. And so that's why we're much more active today in terms of saying, what are the programs that we can support at our various operations to make sure that that social license is the best it can be.
No, absolutely. And it's crucial, clearly. It's becoming more competitive, though, I'd say, if I look at the royalty and streaming space. There's new entrants coming in. How's Franco different from the other streamers and royalty companies?
I'd say two main aspects in terms of our model, and often when people look at our business, they see the benefits of royalties and stream, what a terrific tool it is for investing in the industry. But it's not what we see really as our ultimate competitive advantage, because at the end of the day, we're mining investors. You're investing in mining assets. And so we see really two things about that. The first is technical due diligence. We've got a tremendously strong technical team in management. But also equally as important is having strong technical people on the board. For any deal, management is working it up, proposing it, but the board is like the investment committee. And that discipline between the two helps us make the best technical decisions. And as you so well know, John, in mining, often the best deals that you do are the deals that you don't do.
Yes.
And it's having the good technical team to keep you honest. The other side of it is, fundamental thing that we believe about the industry is it's highly cyclical.
Mm-hmm.
And so to be successful investing in the industry, you can never set yourself a target and say, in this year, I want to grow X percent, because it may or may not be a good environment for doing deals. And so it takes an awful amount of patience. And we're fortunate to have that, a very experienced board that has been through many industry cycles. But it also takes preparation. And for us, that preparation is around the balance sheet. To invest in a cyclical industry, you have to be willing to build up capital in the good times. Yeah. You don't know when the downturn is going to come. When it does come, you need to be prepared and have as much capital available as possible. And so we've always run a very conservative balance sheet in order to set ourselves up so that we can be successful through the cycle.
Yeah, and it certainly is a different time at the moment with this environment of very low rates and cheap debt. That's giving CFOs a lot of option. How do you pitch your value proposition, and what can you offer that others can't, perhaps?
Well, I'd say, for any CFO, their job is to get capital on the best terms that they can. And so that means inevitably we're competing with the debt markets, we're competing with the equity markets. And often in sometimes it's the one, sometimes the other. Often the discussion we're having with a CFO, you hear so often, debt is cheap. I can get cheap debt these days, and that discussion we're having is the cost of debt is not the coupon. The cost of debt is the loss of flexibility. Mm-hmm. It really gets expensive when your debt comes due and the debt markets are shut and you're not able to refinance it. The beauty of your stream is that there never is a principal repayment that is due. The other side of debt are covenants, which can also be very restrictive, particularly for project debt. I remember a case we're dealing with a party that we're helping finance, and part of it was refinancing their debt package. It really had constrained their ability to grow the company. So we said, we'll send over the debt documents so we can see what we're getting into. When they sent it over, it was amendment number 16 to their debt facility. And we were like, okay, we understand. Yeah. You are keen to get rid of this facility. I must say in the mining industry, that is changing. Fewer banks playing in the project finance market. So less of those restrictive covenant heavy type financings, more so in recent years, I would say it's been the private debt players, typically covenant light, but it's more expensive money. You're speaking 10% plus money. So the low cost of funds that we provide is very competitive against that. The other side of it is on the equity side. And more so it's when we're looking at early stage equity investments that the CFO is saying, shall I do a stream or shall I raise equity? Maybe a good example is we did a deal about this time last year. It was with Sol Gold, their property, Alpala down in Ecuador. But the decision they faced at the time, market cap went down to about 400 million. They needed to raise about 100 million. So it would have been 20-25% dilution for their equity holders. But they have in Ecuador, not just one project, they've got a terrific land position. They believe ultimately they'll have 3, maybe 5 good projects in the country. If they had done an equity financing at the time, they would have diluted their current shareholders to the tune of 20-25% in all those projects. Yeah. What they did with us, we bought a royalty. It's a 1% royalty, but it only applies to a single of those properties. So comparing the burden or the dilution from selling one royalty on one project compared to very heavy equity dilution across everything they might own was a very simple decision for the company.
Good. We are rapidly running out of time, so I'm going to fire up one quick fire question for you. Investors have come to expect dividend increases at Franco every year, but with your year end, you increase your dividend by more than usual, up 15%. Have you changed your dividend policy?
Our dividend policy is more a philosophy than anything, and that is that the dividend should be, number one, sustainable, and number two, progressive. And sustainable means the board never wants to ever have to cut the dividend. And so we'll always be conservative. The second is they're very proud. For every year of the last 13 years, they've increased the dividend. And so they would very much like to be in a position that each year they can continue doing that. What allowed a bigger increase this year really is Cobre Panama. We have put 1.35 billion into the project over a number of years. Started in 2019, really 2020 was the first full year that the asset was running. It's been a big step up in our growth. And so really that increased dividend in my mind reflects the increased cash flow that we now have from Cobre Panama and the ability to make a bigger payout.
Fantastic. Well, look, it's been fascinating, Paul. I think we could talk all afternoon, but I'm getting frantic wind-up signals here from the organisers. I'd like to thank you very much for your time, and I look forward to catching up with you in person, hopefully later this year. So best of luck to you and Franco, and I hope things go well. Thank you.
Well, thank you, John. Always a pleasure to chat to you.